Welcome friends. Hope your preparations for November 2022 is in full swing. As we know, ICAI has released a revision test paper or RTP for November 2022 exam. What we are going to cover in this video is to understand the full working of the solutions to the various MCQs given in the RTP for direct tax as well as for indirect tax. And the reason is while the RTP contains the full working and the full solutions for the non-MCQs, for MCQs including case scenarios only the final answer is given. So sometimes it becomes challenging as to understand the logic and reasoning why a particular answer has been arrived at. So first we will deal with the MCQs for direct tax and then we will move on to indirect tax. While doing so, we will look at the extracts of some of the selected provisions and we will refer TaxBook Plus for understanding the provisions in this respect. Okay, so let's begin with the case scenario for direct tax. The question says High-Tech Limited, a real estate development company, entered into an agreement with Mr. Sakshar, a resident individual, on 25th June 2019, as per which Mr. Sakshar agrees to transfer of plot of land measuring 12 acres in New Delhi to High-Tech Limited. Mr. Sakshar purchased such land on 14 July 2017 for 80,50,000 rupees. High-Tech Limited has planned to develop a high-rise society of 250 flats on such land in consideration of transfer of land by Mr. Sakshar. High-Tech Limited paid a part consideration of rupees 1 crore, so this is in cash, to Mr. Sakshar on the date of agreement and would provide 3 flats in the society to him as final settlement. So Mr. Sakshar is supposed to get rupees 1 crore in cash plus 3 flats as consideration for transfer of the plot of land. Okay. The certificate of completion of society was issued by the authority as on 10th August 2021. On such date, stamp duty value of each flat in the society was 2 crore 51 lakh. Subsequently, on 31st August 2021, Mr. Sakshar sold 2 flats. Out of these 3 flats, he sold 2 flats in the society to Mr. Kevin for a consideration of 2 crore 70 lakh each, while the SDV of each flat on such date was 2 crore 98 lakh. During the previous year 21-22, Mr. Kevin has earned salary income of 30 lakh 50,000 rupees. The question further states, out of the proceeds received on sale of land, so basically what is being referred to is the cash consideration of 1 crore. So out of the proceeds received on sale of land, Mr. Sakshar has purchased a house on 8 September 2021 for a consideration of 47 lakh and occupied for own residence, self-occupied property. Mr. Sakshar has taken a loan of 35 lakh, 80% of stamp duty value. So this 35 lakh represents 80% of stamp duty value from SBI for purchase of such house, which was sanctioned and disbursed at the interest rate of 12% per annum on 1st July 2021. He does not own any other residential house on the date of sanction of loan. Mr. Kevin and Mr. Sakshar do not opt for section 115 BAC, and then cost inflation index for the various years is also given for 2021-22, for 2019-20, and for 2017-18. So this is the crux of the question, that Mr. Sakshar has transferred a plot of land to a builder, and the builder in consideration has paid cash of 1 crore plus 3 flats. Okay, out of these 3 flats, Mr. Sakshar has sold 2 flats to Mr. Kevin, and out of the consideration of cash of 1 crore, Mr. Sakshar has purchased a self-occupied property by taking a loan from SBI on which interest is being charged at 12% per annum, and he does not own any other residential house on the date of sanction of loan, and both Mr. Kevin and Mr. Sakshar have not opted for section 115 BAC. Now we move to the questions, and before that it's important to understand what are the sections that will apply. Mainly the section which will apply here is section 45(5)(a), which relates to a joint development agreement. There is something that you would have studied while doing the capital gains chapter. Okay, so let's move to the first question. The first question is, what would be the tax, if any, required to be deducted by High Tech Limited in respect of agreement entered into with Sakshar? So this deals with TDS provisions, and if you look at the TDS provisions for joint development agreement, the relevant section is section 194 IC, which says that if payment is made to a resident in the nature of cash consideration, not in kind. So we are not talking about the 3 flats which have been given, but the cash consideration of 1 crore. Under the joint development agreement referred under section 45(5)(a), 10% is the rate and TDS has to be deducted by the builder. So TDS under section 194C will apply on cash consideration under JDA referred under section 45(5)(a). So 10% of 1 crore will be 10 lakh rupees, and this is basically the correct answer. 10 lakh rupees will be the TDS under section 194 IC. Let's move to the second question. What would be the capital gain in the hands of Mr. Sakshar in respect of the agreement entered into with High Tech Limited, and in which year it will be taxable? So it is asking us to compute the amount of capital gain and also ascertain the year in which such capital gain would be taxable. At this moment, it will be useful to take a quick look at the provisions of section 45(5)(a), and I am currently referring to TaxBook Plus. I'll quickly refer, and this is something that you would have already studied. So transfer covered, transfer by an individual. So Mr. Sakshar is an individual of land. Okay, land is being transferred in our case under a specified agreement, and specified agreement is where the owner of land agrees to allow another person to develop a real estate project, which in our case is High Tech Limited, in consideration of a share being land and building in such project. So 3 flats are being given to Mr. Sakshar in consideration plus cash. So 2 aspects arise here. One is what happens when there is transfer of land under section 45(5)(a). What are the capital gains considerations, and then what happens if such share in the form of land in our case is subsequently transferred. In such case, section 49 subsection 7 applies. So when there is a transfer of plot of land in our case, the year of transfer and year of charge are different. So year of transfer is the year in which possession of land in our case is handed over to the developer. So the transfer takes place in which possession of land is handed over to the developer, and the year of charge, that means the year in which capital gain is charged, is the year in which certificate of completion for whole or part of the project is issued by competent authority. In our case, we can say that the year of charge of capital gain under section 45(5)(a) will be the year in which certificate of completion is issued by the competent authority. And if we look at the question, the certificate of completion has been issued on 10th August 2021. That means previous year 21-22. So previous year 21-22 is the year in which capital gains will be charged. In our case, the year of transfer should be the year in which the possession of land has been handed over to the developer. But in the question, the year of possession of land is actually not given. What is given is the date of issue of certificate of completion and the date of entering into the agreement, which is 25th of June 2019. So in absence of information, we can assume that this 25th June 2019 is also the date of handover of the possession. But this is the year of transfer, though the charge happens in the previous year 21-22. The The other part of this question was computation of capital gain under section 45(5)(a). So coming back to the provisions, how is capital gain computed? We know that full value of consideration is the stamp duty value of the share, land in our case, on date of issue of COC plus cash if any. Then we reduce the expenditure of transfer if any. And then we reduce the cost of acquisition or the index cost of acquisition or cost of improvement or the indexed cost of improvement. And in this case, we need to keep in mind that the period of holding runs till the date of handing over of possession, not till the date of issuance of COC, because handing over of possession is basically the year of transfer. While the capital gain is charged in the year of charge, the computation is made in the context of year of transfer. So period of holding runs from the date of purchase of land till the date of handing over of possession, which we have discussed just now is the year in which the agreement has been entered into in absence of any further information. And then consequently we arrive at short-term capital gain or long-term capital gain. So let's look at our question and see what will happen. So computation of capital gain under section 45(5)(a). What will be the full value of consideration? SDV of 3 flats on the date of issue of COC. This is 7 crore 53 lakh. 7 crore 53 lakh because the SDV of each flat in the society is 2 crore 51 lakh multiplied by 3, it comes to 7 crore 53 lakh plus cash consideration of 1 crore. This means 8 crore 53 lakh. So this is the full value of consideration. Cost of acquisition or indexed cost of acquisition. Indexation will not be relevant in our case because this is the short-term capital gain. Why? Because we need to compute the period of holding from 14 July 2017 to 25th June 2019, which is not more than 24 months, and therefore short-term capital gain arises, and simply we need to deduct the cost, which is 80 lakh 50,000, and short-term capital gain becomes 772,500,000, 7 crore 72 lakh 50,000. This is the answer to the second question. 772,500,000, 7 crore 72 lakh 50,000 in previous year 21-22 is the answer. Okay, let's now move to the third question. Determine the capital gain or loss in the hands of Mr. Sakshar in respect of sale of 2 flats to Mr. Kevin during previous year 21-22. So out of the 3 flats, as we know, Mr. Sakshar sold 2 flats to Mr. Kevin. Now moving again to section 45(5)(a) as given in the TaxBook Plus, we see this particular portion. When Mr. Sakshar subsequently sells, the year of transfer as well as the year of charge remains the same, and this is the year of transfer. Actual full value of consideration is taken, and the cost of acquisition. What will be the cost of acquisition? The full value of consideration which we had taken earlier under section 45(5)(a). So this will be taken, and the resultant will be the short-term capital gain or long-term capital gain. Right? So in our case, what will be the position? Computation of capital gain on sale of 2 flats to Mr. Kevin. Full value of consideration is SDV or the full value of consideration. So if you look at the question, what does the question say? Mr. Sakshar sold 2 flats to Mr. Kevin for a consideration of 2 crore 70 lakh for each flat, while the SDV was 2 crore 98 lakh. And here we will need to consider section 50C, where if the SDV is more than 110% of the consideration, then under section 50C, the SDV will become the full value of consideration, which will be the situation in our case. So since SDV is greater than 110% of consideration, 5 crore 96. Why 5 crore 96? Because 2 crore 98 lakh multiplied by 2 for 2 flats. So this becomes the full value of consideration, and the cost of acquisition is the full value of consideration taken under section 45(5)(a). Now the full value of consideration, if you look above, was 8 crore 53 lakh. Now this was for 3 flats, but since 2 flats have been sold, this multiplied by 2 divided by 3 will be this cost of acquisition, and short-term capital gain will arise because the transfer has taken place during the same previous year, 31st August 2021. So again, the period of holding doesn't exceed 24 months. So short-term capital gain, and this will be 2,733,334. So this will be the answer to this question: capital gain or loss in the hands of Mr. Sakshar in terms of section 49(7). Question 4. What would be the total income of Mr. Kevin for the previous year 21-22? Total income of Mr. Kevin. So we need to figure out what are the details of incomes of Mr. Kevin which are given in our question. Two incomes are to be considered. One is the salary. Okay, the amount is given of 30,50,000, and then we reduce standard deduction and 30 lakh comes. And then income from other sources will also apply because taxation will happen under section 56(2)(x) because flats have been received without adequate consideration. There is a gap between actual consideration and the stamp duty value. So excess, which is the excess of stamp duty value of 5 crore 96 lakh over the consideration of 5 crore 40 lakh, is the gap. Basically the gap is 56 lakh, and twin conditions which need to be satisfied is this: excess is more than 50,000 and stamp duty value is greater than 110% of consideration, and therefore the excess of 56 lakh becomes taxable under the head IFOS, and consequently the total income is 86 lakh. Total income of Mr. Kevin will be 86 lakh. And finally, we are asked to compute the total income rounded off of Mr. Sakshar also for the same previous year. Now let's see what will be the total income of Mr. Sakshar. So if you look at the total income, short-term capital gain under section 45(5)(a), this is something that we already computed above, 77250,000. Then short-term capital gain on sale of flats to Mr. Kevin. This is also what we computed above. And if you were thinking that you can apply exemption under section 54F on purchase of house because land has been sold and house has been purchased, it's not possible because 54F comes into play only when there is long-term capital gain, but we had short-term capital gain. So this becomes the income from capital gain. But now we also need to move to income from house property, because now he got 3 flats out of which he sold 2 flats and he again purchased 1. Let's see the question above. So he got 3 flats, okay, he sold 2 flats, and out of the proceeds he purchased a house, and then there is this interest on borrowed capital as well. So income from house property will need to be considered, and the NAV will be nil since the house is self-occupied, and we will need to reduce or deduct the interest on borrowed capital, which will be, as per the details given in the question, 12% per annum for 9 months. It starts from 1st of July. On 35 lakh, which is a loan amount, this is 3,15,000, but the limit of deduction under the head IHP is 2 lakh, so this is 2 lakh, and therefore loss from IHP becomes 2 lakh, which can be set off against the short-term capital gains, and therefore after being set off, this becomes the gross total income, 797,833,334. But now we need to also consider section 80EEA, whether a deduction can be given under section 80EEA as well. So let's take a quick look at 80EEA. This is what the TaxBook Plus says. Let's take a quick look. An ATEEA is available to an individual on acquisition of residential house property if the loan is taken from a bank, and the condition are this is basically not that much of relevance. So number two, loan is sanctioned during this period. In our case, it's previous year 21-22. This is satisfied. SDV of house property should not exceed 45 lakh. Now, in our case, the SDV doesn't exceed 45 lakh, and SSE does not own any RHP on the date of sanction of loan, and therefore the interest payable during the previous year up to a limit of 1,50,000 is allowable as deduction. Now let's look at our case. In our case, deduction under section 80EEA can be taken in respect of the balance interest of 1,15,000 which we could not claim under the head IHP. Because all the conditions have been met, loan has been sanctioned during the previous year 21-22. SDV of house of 43,75,000 doesn't exceed 45 lakh. And how did we arrive at this amount? Because 35 lakh was 80% of stamp duty value. So if you consider 100%, it comes to this amount, which doesn't exceed 45 lakh. And he does not own any house on the date of sanction of loan of 1st July 2021, because this is given in the question also, and also because the two flats that he received, the certificate of completion was obtained only on 10th of August. So in any case, this condition is satisfied. So 1,15,000 is something that you can claim as deduction under ATEEA, and consequently this is the total income, and this is what comes as the total income rounded off. Our answer to the fifth question will be 79668,330. 79668,330. So this is the answer to our case scenario MCQs. Now you look at this. In our case scenario, multiple angles are involved. TDS is involved, capital gain is involved. In capital gain also, you need to take into account 45(5)(a). Then you need to figure out the period of holding. Then you need to also figure out section 50C. And then you need to compute salary. And then there is 56(2)(x) under income from other sources. And then you need to also consider whether you can apply 54F or not. And then income from house property also comes. Deduction of interest, set off, and then finally deduction under section ATEA and rounding off as well. How do you round off? So many angles are there, therefore it's critical. If you really want to succeed in the CA Intermediate tax exams, it's really critical to have a really solid grasp on interlinking concepts. For your benefit, there is something called as an interlinking compiler, which I call Tax Cruiser. It's free of cost, and it's available on tax.sharad.com. What you need to do is, if you don't have it yet, then you can just go and sign up on the Tax Cruiser pack and then download the Tax Cruiser and go through it. And if you read it along with TaxBook, that's the ideal way to do it. But otherwise, on a standalone basis also, Tax Cruiser will be simply great for you. Interlinking is really very important, because then it becomes very difficult to crack the various practical questions. And almost all questions are practical when you talk about tax paper. Okay, now let's quickly come to our next MCQ. MCQ number 6. Mr. Raj, aged 65 years, is a salaried person. He has taken a life insurance policy on his major son's name on 1st November 2014. The sum assured is 16 lakh and the premium payable is 1,70,000. He has also taken a medical policy of 10 lakh for self and his wife on 1st November 2021. The medical policy is valid for 5 years. He has paid one-time premium of 1,80,000. What is the total deduction available to Mr. Raj for AY 22-23? Okay, so if we look at TaxBook Plus, so 2014, and therefore the limit of deduction is up to 10% of sum assured, and the limit under section ATC is 1 lakh 50,000. So in our case, deduction under section 80C for life insurance policy for major son, whether the son is minor or major, the deduction will be given. Deduction up to 10% of sum assured, which is 1,60,000, but the deduction under section 80C will be limited to 1,50,000, right? Now, if you come to section 80D, if there is a multi-year payment being done at one go, then we need to distribute the deduction. And the distribution is the amount paid divided by total number of previous years comprised in the period, beginning with the previous year in which the amount is paid and subsequent previous years during which insurance will be enforced. Now here in this question we are told that the policy is valid for 5 years. So should it be 5 years? Should be distributed for 5 years? Let's see. Deduction under section 80D for each previous year will be amount paid of 1,80,000 divided by total number of previous years comprised in the period from 1st November 2021 to 31st October 2026, which means 21-22 previous year to 26-27 previous year, which is not 5 years, which is 6 years. So per year it comes to 30,000 and the total deduction comes to 1,80,000. So 1,80,000 is the correct answer in our case. MCQ number 7. Mr. Karan completed his MBA in April 21 and joined XYZ Limited from 1st May 2021. His basic salary is 2,25,000 per month. He's paid 12% of basic as DA forming part of retirement. He contributed 11% of his pay and DA towards RPF and the company contributes the same amount. Accumulated interest on PF as on 31st March 2022 is 49,325. What would be the income chargeable to tax under the head salaries of Mr. Karan for AY 22-23 if he does not opt for section 115 BAC? In order to solve this question, let's quickly look at the provisions so that you will understand what to do basically in this question. So if you look at RPF, employee's contribution is exempt up to 12% of salary, which is basic plus DA if terms of employment so provide, which is our case. Also, it is taxable if the combined employee's contribution for recognized provident fund plus approved superannuation fund plus NPS exceeds 7.5 lakh, which is not our case, right? Interest credited on employee's contribution is exempt up to 9.5%. And if the RPF, ASF, NPS contribution exceeds 7.5 lakh, then the attributable interest also gets added as per computed under the relevant rule. Now, interest which is credited on employee's contribution is exempt up to 9.5% per annum, but interest relating to employee's contribution is not exempt. That means it's taxable in certain cases. We will look at those cases. Now this is a recent amendment. Interest accrued during the previous year relating to employees' contribution to RPF is not exempt, right? What is the extent of that interest? Interest accrued relating to employees' contribution which exceeds the following amount. Contribution from previous year 21-22 is relevant because in our case Mr. Karan got employed starting from this year itself. There is contribution by both employee and employee. This is the case in our hand and therefore the limit is 2.5 lakh. So if Mr. Karan's contribution exceeds 2.5 lakh during the year, then interest related to that excess contribution will not be exempt anymore and it will be taxable. Rule 9D is relevant in this respect, which has been recently issued. And basically what it says is income which is not exempt, as we just now discussed, shall be computed as the interest accrued in the taxable contribution amount. That means we need to first calculate the taxable contribution account and the amount in that account, and then we need to figure out the interest accrued in that account. That will be the amount which will be taxed. It won't be exempt, right? So taxable contribution account, basically the account for the SAC will need to be split into non-taxable contribution account and taxable contribution account. The interest which is in relation to this account will be exempt, and the interest which is in relation to taxable contribution account will be taxable. We are concerned with taxable contribution account. Now, taxable contribution account in our case will comprise of which amounts? Contribution made by the person, that means Mr. Karan in our case, in the previous year 21-22 and subsequent previous year. So 21-22 is relevant, which is in excess of threshold limit, which was 2.5 lakh in our case. And interest accrued on subclause I, which is not relevant because this is the first year itself. This will be relevant from the next year onwards. So basically what we need to do, we need to figure out the amount of interest which is in relation to the amount contributed by Mr. Karan in excess of 2.5 lakh. So this is the essence of the provision. Now come to our solution. So in our solution, let's look at how to compute the income under the head salaries. Basic, DA is 12% of basic, right? Employer's contribution to RPF, it's exempt up to 12% of salary, so nothing. Interest on employer's contribution is exempt up to 9.5%. Also, as we just saw, that combined contribution to RPF, ASF and NPS is not greater than 7.5 lakhs, so nothing on account of this. Now we need to worry about interest on employer's contribution exceeding 2.5 lakh during the previous year. Now this is taxable under section 10(12) read with rule 9D. Now employer's contribution is 11% of 27,72,000, which is the aggregate of this, which comes to 3,04,920, which is more than 2,50,000. Excess is 54,920, right? The total accumulated interest for the year is 49,325, which is given in the question. Now this 49,325 is on account of employees' contribution also and employer's contribution also, right? So the contribution of both comes to 3,04,920. This is employees and employers' contribution of the same amount as well. So this is the total. 609,840 is the total contribution, on which interest at the end has been 49,325. And we need to figure out basically the interest relating to 54,920. So what we need to do, 54,920 divided by 609,840 multiplied by 49,325. So this is the proportion, and the interest which will not be exempt, it comes out to 4,442. We get the gross salary income and then standard deduction, and then this becomes the salary taxable income under the head salaries. 2726,442. 2726,442 is the answer. Now here two views are possible. One view which has been considered by ICAI in solving this question is that interest on employees' contribution will also get included in the taxable salary income. The alternative view is that interest, since it doesn't have to do anything with the employment as such, it's the interest on employees' own contribution, it should not get taxed under the head salaries, but it should get taxable under the head income from other sources. But in our case, we can assume and we can go with the view that ICAI has taken on this count, and therefore accordingly this becomes the answer to this MCQ. So question number 8, let's see. This is the last MCQ for direct tax. Mrs. Kajal, the general manager of Mrs. Gold Limited, was paid a salary of 4,50,000 per month. The above salary includes non-monetary perquisites of 50,000 per month. Includes. As per the terms of employment, tax on non-monetary perquisite is to be borne by Mrs. Gold Limited. Mrs. Kajal's contribution towards PPF is 1,50,000. What would be the amount of tax to be deducted under section 192? by Mrs. Gold Limited from the salary of Mrs. Kajal if she intimated Mrs. Gold Limited to opt for provisions of section 115 BAC. So what we are told is that the salary is 4,50,000. Out of this, the employer has agreed to bear the tax liability on the non-monetary perquisites amounting to 50,000 per month, and we are asked to compute the TDS under section 192, not from the non-monetary perquisites, but which will be deducted from the salary, and 115 BAC has been opted for. So let's see what will be the scenario in our case. Salary including all perquisites is 54 lakh for the year. Tax on non-monetary perquisites, which is paid by the employer on behalf of employee, is really not a perquisite because it's specifically exempt under section 10(c). So we need not add anything on this account. Standard deduction is not to be deducted, and ATC deduction on account of PPF contribution is also not to be deducted, as she has opted for 115 BAC. So the total taxable income comes to 54 lakh, and the tax including surcharge and HEC under section 115 BAC comes to 15,52,980. So this is the tax basically which should be deposited with the government. But out of this, the tax on non-monetary perquisite will be borne by the employer, and the rest will be borne by the employee, and therefore it will be deducted under section 192 from the salary. So for this, what we need to do, we need to figure out the average rate of tax. An average rate of tax is 15,52,980 tax divided by the total income multiplied by 100, and therefore 28.7589%. You can take it till 2 decimal places also, but then there will be a rounding of error because the amount is huge, and then you may see some difference in your answer and the answer option in the MCQ. So to match, I have taken it till 4 decimal places to be as accurate as possible. So 28.7589%. Now tax at this average rate on 6 lakh, which is 50,000 per month of non-monetary perquisites, needs to be borne by the employer. So this becomes the amount, and tax to be deducted from salary is at the same rate on 48 lakh, which is 54 lakh minus the 6 lakh on which the employer has borne the tax. So 48 lakh is something on which the TDS needs to be deducted under section 192 from the salary income which is being paid, and this comes to 1380427. So 1380427 is the answer to this question. So we have completed the MCQs, the case scenario MCQs and the independent MCQs for direct tax, and now let's quickly move on to indirect tax. For indirect tax, I must say it's really a breeze. It's really very simple, and but still let's I'm sure that almost all of you should have solved all the MCQs correctly for indirect tax, but let's quickly move on and look at the solutions for ourselves. Messrs. Delight Brothers, a partnership firm, is engaged in restaurant business. It is registered under the composition levy scheme under section 10(1) and 10(2). For the current financial year, its turnover in the state for the month of April was 12 lakh. It received new orders in the month of May to run a mess facility for supplying food at a school, an institute of technology, and a hospital. It also provided catering services to a company for their AGM. It was provided, so the service was provided on 3rd July. But invoice was not issued by the firm to the company. However, payment was received on 25th July, for which bank account was created on 20th July. The turnover of the restaurant business for the current financial year is 48 lakh. From the inception of next financial year, from the inception, that means from 1st of April, Messrs. Delight Brothers will close down the restaurant business and will provide service of repairing of air conditioners. So no sale of goods, only provision of services. And they undertake intrastate transactions only. And therefore, our first question is to compute the tax liability of Messrs. Delight Brothers for the month of April. Now, under the composition scheme, Under the composition scheme, the rate for restaurant services is 2.5% for each of CGST and SGST. This percentage of turnover in the states. So accordingly, if we compute this on turnover, which is 12 lakh, it will be CGST and SGST of 30,000 each. Next question is, out of new orders received by the firm in May, which of the following services are exempt? So these were the new orders for providing mess facility for supplying food, so catering service. Studied while noting the exemptions that catering is exempt under entry 66 of exemption notification only for a school. It's not exempt for any other educational institution, and also not exempt in the case of a hospital. So in our case, it will be only school, that means only I. So this will be the answer. The third question is, we need to figure out the time of supply for catering services provided to the Coral Limited company. It's catering, so it's not RCM, it's forward charge, right? And invoice has not been issued, but we know the date of receipt as well as the date of provision of service. So time of supply for services under forward charge is earliest of date of provision of service, as invoice is not issued within the prescribed period, which is 3rd of July. And date of receipt of payment, which is earlier of 25th July or 28th July, which is 25th July. So earliest of these is 3rd July. So the answer to this question is 3rd of July. Question 4. Which of the following statements is most appropriate in respect of next financial year? So as we looked at in the question, Messrs. Delight Brothers will discontinue the restaurant business and start a pure service business from the next financial year. Composition scheme for services can be availed under section 10(2)(a) since it's a service business, but the condition is that the turnover in the preceding financial year should not exceed 50 lakh. In our case, in the question, it's already given that the turnover for the current financial year was 48 lakh, so this condition is met, therefore it can avail of CSS under section 10(2)(a) for the next financial year. And therefore, option C is the correct option. Rate of GST applicable for service of repairing of air conditioners will be, which is in the next year, assuming that it intends to pay the tax at the minimum rate available. So minimum rate will obviously be under CSS under section 10(2)(a), and we know that the rate under section 10(2)(a) is 6%, which is 3% CGST and 3% SGST. So this will be the answer to our case. So this brings us to the end of MCQs for both direct tax and indirect tax. You can cross-check this video if you want to understand the full working notes and the logic and the reasoning of all the answers. Hope this video will be useful to you, and all the very best to you. Thank you very much.